Let's see what's going on with a growth stock versus a value stock. Because I know a lot of you probably wonder what is the difference between that. A lot of times, what people say, if you're somebody who looks like Warren Buffett looks at value. You know what I'm saying? He looks at value. He looks for stocks that may not be the best at the moment in time. The stock price might be pretty low, which means you can get them on discount, of course. But, by value, he pretty much means, hey, you hold on to it. The company is valuable. It's contributing to society a lot. So, that means that over time it's definitely probably going to be profitable. And if it's profitable, that means you will probably be profitable. You understand? Growth is essentially a stock that you already know is going to grow simply because, the company is kind of getting, revenue over time. Like it's just constantly growing, so you can feel that. Now, we're going to take a look more into the details of this and what really is the difference, because even me, I'm a little confused about genuinely the difference between a growth stock and a value stock. I mean, a value stock could grow, but a stock can technically hold a lot of its value and still be valuable. You know what I'm saying? While as a growth stock, clearly in the name, has to grow. So let's see what's going on with this. So it says growth stock versus value stock. It's all in the eye of the beholder. Okay. So now it says value versus growth. Sometimes it's hard to tell the difference, and sometimes it may depend on what index you're using. Interesting. Is Microsoft a growth or a value stock? Many investors would say that it's a growth stock because it has traditional characteristics of a growth stock's. Earnings are growing. Obviously, earnings and revenue is going to have to be big with a growth stock. A value stock, I wonder if that's still, I mean, obviously you have to earn to be a value stock, but I wonder if it's more about you just actually contributing over time. Maybe you don't have to grow much, but you at least hold your value. Maybe that's really the difference. A lot of times you can have risky investments where you throw your money into something that's really volatile. It's going up in all the place, and maybe you want something that's just gonna have a steady increase. You know what I'm saying? Nothing too crazy, like growing too crazy, but nothing that's going to just drop 20% in one day because of a news article or something like that. And that could be where possibly value stocks come into play. Now, it says, but Microsoft is now being classified as partially a growth stock by Standard and Poor's and partially a value stock. Huh. What about Meta? As you guys know, Meta, Facebook. Shout out to Mark Zuckerberg. What a strange guy. I feel like he's just always making extremely weird. He just doesn't look like a real human being. Like, let's look at Mark Zuckerberg. Excuse me. Like, look at him. Like, he doesn't really look like a real human being. He just kind of looks like a robot almost. He almost looks like AI, like what I would expect like a real AI like person to look like. Especially like when you got pictures of this, like I don't know how well you guys can see that, but especially when you have pictures like that, like come on. Yeah, but yeah, shout out to Zuckerberg. Great guy, great guy. But look at these pics of him. It's funny. It's very funny. But let's see. So it says S&P now says it is 100% a value stock. We need to get into why. Why is it one? So it goes on to Exxon and a bunch of other stocks and things like that. Now it says value is dead in the triumph of indexing. Well, I wonder what it means by that. Let's see. In an interview on CNBC last week, Greenlight Capital co-founder David Inhorn said value investing is a industry is dead. The money has moved from value investors to index funds and it's not coming back. So they're basically saying people are taking their money out of that and putting it into index funds. As you guys know, index funds, a collection of funds, for a certain sector that you can throw your money into. And, it basically makes it a lot safer for you because as opposed to investing into one particular stock, you're actually investing into multiple companies at once. So like I said before, if one stock gets hit, the CEO gets caught cheating on his wife, something like that, instead of the stock just tumbling down 15%, then you'll be cushioned by those other stocks. And if the industry is doing well, then you'll be fine. If the industry's not doing well, then you'll probably deal with some issues. Now, let's see here. He said he's certainly right about one thing. A decade of outer performance by growth stocks has left a smaller pool of value investors, and much of the value investor money and a lot of other people's money has moved into indexing. I wonder if this was also brought on possibly by C19. In C19, we saw a lot of stocks really like get punished and then grow. A lot of people were really able to make a lot of money in C19. Basically, you could kind of close your eyes and just kind of, just kind of throw darts. And, after C19, the recession started kicking in, we all saw what reality really is. But, I could see kind of the sentiment changing because of that type of nature. And also, let's be real here. For the last 20, 30 years in the stock market, especially if you were looking into tech, if you just were to close your eyes and throw a dart on a door, Microsoft, Bing, Google, Chrome. I just said the companies and their subsequent, websites. But you guys get what I'm saying. If you were to Apple, Apple, Facebook, like Tesla, then you would have made a ton of money. You would have made a ton of money. So I could see why people would really be looking into something like that. Now it says, because of the triumph of indexing, they don't try to buy individual stocks they think represent growth or value anymore. They just buy indexes or indices, or more accurately mutual funds or ETFs that track those indexes. And actually, I mean, as a person that used to trade a lot of individual stocks, now I do buy, I can't lie, a lot more indexes. They're just much safer for me. Indexes and mutual funds are kind of like my bread and butter, and everything like that, where I like to put a majority of my money. And if I feel a certain type of way about a company, I see some good news, maybe I hear multiple instances of good news that make me really see a good future for it, then I may buy a little individual stock. But overall, if I've got $100, I'm probably going to be throwing, 70 or so percent, at least in something like an index fund, because it's just safer. And when you're thinking safer long-term investments, it just makes more sense, Now, it says there are several large growth and value ETFs that have attracted big money. The iShares S&P Growth and iShares Value are based on indexes developed by Standard & Poor's, who I'm sure you guys have heard of. Also, you guys know this is my favorite one here, like Vanguard. You guys gotta love Vanguard. Vanguard Growth and Vanguard Value funds, which are based on indexes developed by the Center for Research and Security Prices. iShares Russell Growth and iShares Russell Value also provide competition. I got you guys here. I gotta recommend Vanguard. I can't not recommend Vanguard. How could I? Like, it's really like the best one, to be honest. Like, I mean, don't get me wrong, there's a lot of best ones, but Vanguard's made me a lot of money in the past. It's been really good. I still hold on to a lot of Vanguard, and I just feel like they have so many options. They have, if you want to trade domestically, if you want to trade internationally, if you want to trade completely worldwide, as in domestically and internationally. They have, if you want small cap, mid cap, large cap stocks, if you want to get into biotechnology, if you want to get into commodities. Vanguard's got everything you need. So I'm just going to have to recommend Vanguard for all my guys and ladies out there. You know what I'm saying? Now let's see. It says S&P growth and value criteria. It's not that simple. It says the S&P rebalances its growth and value indexes every year at the end of December. This is fairly routine, but because of the wild price action last year, a lot of stocks have moved at least partially from growth value and vice versa. Yeah, which makes a lot of sense. You guys already know, like, the market's been volatile this year. A lot of people have been holding money, and now they're like, hey, like, I want to take my money out. I'm tired of these ups and downs. Like, people got to realize volatility can be almost as bad as, a stock just going down, because you don't know what's going to happen with your money. Think about it. If your life savings is tied into something, your 401k is tied into something, do you really want it to be up 15% this year, down 10% the next year, up 20% this year? You know what I'm saying? Down 10%. That's a lot. You'd rather just want something nice and safe, a little 5% a year, something like that. Something not too crazy. You know what I'm saying? Now, let's see. The S&P 500 market capitalization is divided roughly equally into growth and value. One of the quirks of the indexes is it's rare when a stock gets classified as just a value or growth stock. So, I guess they can technically be part and part. Now, there are 3 criteria to be in a growth. This is where it gets good. This is where it gets interesting. A 3-year change in earnings per share. Okay, so a 3-year change in earnings per share. 3-year change in share and sales per share, and a 12-month price momentum. Higher is better. Now, there are 3 criteria for it to be considered a value stock. That would be lower book value to price, lower earnings to price, and lower sales to price. So now we actually have a real look at what really makes the difference between this. And I can understand kind of why you would be, especially nowadays, why you would be more associated to look into, growth. Now, it says each stock gets weighted with each criteria. Each stock ends with a growth score and a value score. It goes into why Microsoft partially is considered value, why those are considered that. Okay. Well, I feel like we get a little bit of an idea on it. I don't really want to touch too much into this subject, just because I don't feel like it's the most interesting one, but it was always something I was wondering, and I wondered if you guys ever wondered about it too. So just kind of wanted to make a video on that and kind of think about it.